When we think of super expensive art, we usually picture someone who just really loves culture, right? But what if I told you that a painting that costs millions of dollars isn't just about art? What if it's actually a seriously sophisticated financial tool? Yeah, today we're going to peel back the canvas and look at how art can become this kind of clever and sometimes very illegal way to dodge taxes.
I mean, you've seen the headlines, right? Some painting that's literally just a blank white square sells for $20 million. And you're sitting there thinking, that person has got to be crazy. It just seems totally disconnected from the real world. But what if they're not crazy at all? What if they're playing a completely different game than the rest of us?
Yeah, what if I told you they just saved millions of dollars in taxes? Suddenly, that crazy purchase doesn't seem so crazy anymore, does it? It starts to look incredibly strategic. That painting might have just unlocked a huge financial win that honestly has almost nothing to do with what's on the canvas. Okay, so let's break this down. To really get how this works, we're going to walk through what we'll call an investor's playbook. Think of it like a step-by-step guide to a super aggressive tax strategy that some people have used to, well, pretty much game the entire system.
All right, before we dive in, let's cover a super basic concept, the tax deduction. It's actually pretty simple. It's just an amount of money you get to subtract from your total income before the government figures out how much tax you owe. So naturally, the more deductions you have, the less tax you pay. It's a simple idea, but this little tool is the absolute key to this whole strategy.
So how does something so simple get, well, exploited? Let's use an analogy you can probably picture. Imagine you're at a garage sale and you buy an old chair for, say, 50 bucks, okay? Then you call up a friend, an appraiser, who says, wow, this isn't just an old chair, it's a rare antique worth $5,000. So what do? You donate that chair to a charity and then claim a $5,000 tax deduction. You see what happened? You spent 50 bucks, but you got a tax break as if you'd given away 5 grand. That's the basic idea we're talking about here, just, with a lot more zeros at the end.
Okay, so that little garage sale trick, it scales up into what we're calling the gilded loophole, and it really only has 4 steps. Step 1. Our investor buys some art from a new, up-and-coming artist. Something with potential, but not a crazy price tag just yet. Step 2. They get that all-important, very friendly appraisal that says the art is worth way, way more. Step 3. They make a generous donation of the art to a museum. And step 4, the grand finale, they claim a massive tax deduction. And, this is the key, it's based on that inflated value, not on what they actually paid.
All right, so let's talk numbers. How much cash are we really talking about here? Let's do the math and see how a simple piece of canvas can be turned into a huge financial win.
So, our investor kicks things off by buying a piece of art. Let's say the price tag is $100,000. That's their real out-of-pocket cost. That's the actual money they're putting into this whole scheme.
Now they hang on to the art for a bit, and then they call in that appraiser. And this, my friends, is where the magic happens. The appraiser comes back with a valuation of a cool $1 million. Just like that, it's a 10x increase. A value that was basically created out of thin air, completely on paper.
And here's a great way to see that magic trick. Look at this. On one side, you've got the real cost, the 100 grand they actually paid. But on the other side, you have the $1 million value that was just made up for tax purposes. The entire scheme, the entire profit, lives inside that gigantic gap between reality and paper.
Now, to really understand how wild this is, let's put it in perspective. Let's say our investor took that same 100 grand and just put it in the stock market. And let's say they had a great year, a 10% return. They'd make $10,000. Nice. But with the gilded loophole, by donating the art and getting that $1 million deduction, they could save something like $400,000 in taxes, give or take, depending on their tax bracket. Think about that. It's not real money they earned, it's money they didn't have to pay to the government. A huge difference.
Okay, at this point, I'm sure you're thinking, hold on a second, this sounds way too good to be true, and maybe, just maybe, a little bit illegal. Well, you would be absolutely right. There is a massive catch, and it's a catch that involves the tax man knocking on your door. Which brings us right back to that central question, is this strategy just too good to be true? There's a golden rule in finance. If something looks like a guaranteed home run with unbelievable returns, it almost always is. And you can bet your bottom dollar the IRS is paying very, very close attention to stuff like this.
And believe me, the risks here are no joke. We're talking severe. If you get caught, you're looking at a full-blown IRS audit and investigation. You'd have to pay back every single dollar you saved, plus some really painful financial penalties. But it gets worse. This can easily cross the line from a clever strategy into straight-up criminal tax fraud. And that means you could face actual jail time. Suddenly that $400,000 profit vanishes pretty fast, doesn't it?
So why does any of this matter? I mean, it's not just some interesting story about one person trying to pay less in taxes. A scheme like this really points to a much bigger conversation we need to have about fairness and about whether our financial system is really on the level. Think about it. The whole reason we have charitable deductions is for a good cause, right? It's to encourage people to be generous, to donate to museums and charities. The government gives you a little tax break as a thank you for doing something good for society. But this kind of exploitation completely flips that idea on its head. It stops being about giving back. It's just about creating a paper-thin loophole to slash your own tax bill. And you know who makes up for that shortfall? Everybody else. And that really is the heart of the matter. For a certain slice of the population, high-end art isn't just something pretty to hang on the wall. It's treated just like a stock or a piece of real estate. It's a financial tool. It's a place to store wealth. And, as we've just seen, it can be a vehicle for creating tax advantages that most of us could never dream of. Which leaves us with one last and much bigger question to think about. If a simple painting can be twisted into a loophole like this, it really makes you wonder, doesn't it? What other gilded loopholes are out there, hiding in plain sight? What other parts of our financial system are being used in ways we can't even begin to imagine?